Kia ora, and welcome to the Reserve Bank's panel discussion on our latest financial stability report, which is reviewing the health of the financial system. New Zealand, as you well know, and the rest of the world is being tested by the unprecedented health and economic crisis as a result of the COVID-19 pandemic. It's prompted governments and central banks to act swiftly to contain the virus and cushion the blow to households and businesses. The economic shock we are facing is one of the largest in our history and is a stern test of the resilience of our banks, insurers and other financial players. I'm Patrick O'Mara, and to discuss the health of the financial system, I'm joined by the bank's Head of Financial System Policy and Analysis, Toby Fines, and Chris Bloor, the Manager of Financial Systems Analysis. We'll also answer some of your questions that you've sent us that you have for the bank. Toby, if I could start with you. Look, first up, just what were the main findings from May's financial stability report? How is the financial system coping? And I guess for most people, they'll want to know, can they be reassured that their bank is safe?
Yeah, thanks, Patrick. Good questions. Well, as you said, the economic shock has been huge, and it's inevitable that this will cause some pain to the financial system. It's actually pleasing that the banking system entered the crisis in a relatively strong position. So capital and liquidity buffers were strong. These have been built up over the last dozen years or so since the global financial crisis, in part in response to better regulatory requirements. We've also pulled out a number of stops to ensure that liquidity and funding are plentiful and cheap. We've also moved some regulatory barriers, so we try to clear the decks for the banks, such as relaxing loan-to-value ratio restrictions and the liquidity core funding ratio, in order to facilitate the flow of lending to where it's most needed in the economy and to people. This means that we think banks are well placed to support their customers through pretty difficult times. And one of our key messages is that banks should use their resources, whether those are physical, human, financial, to continue lending. But on the other side, the banks are not invincible. We ran stress tests on their balance sheets based on one of the more pessimistic scenarios that Treasury put out. These stress tests indicated that without mitigating actions by ourselves or by the banks, their capital positions would be challenged by some of the more adverse scenarios. But those are relatively tail scenarios, they're not the central projections. And I think our key message here is that banks have the wherewithal and should continue to lend to support their customers.
Thanks, Toby. Well, Chris, if I can just go to you first up. Toby Ware was mentioning the stress tests to, I guess, test the resilience of the banks. Look, can you just walk us through, when we talk about stress tests, what do we actually mean?
So really just a stress test is a financial projection of what will happen to a bank given a certain set of assumptions or a scenario. So when we do a stress test, we'll come up with an economic scenario and then we'll try and project what's going to happen to borrowers through that scenario, how many borrowers are likely to default, and what will that mean for the profitability of the bank and ultimately their financial resilience.
Okay. Well, so you, given I guess the uncertainty that we've had around the economic outlook so far because of COVID-19, what scenarios did you use here to test the bank's resilience?
Yep. So we came up with a set of scenarios in April, and this was really the height of the uncertainty as we were in level 4 lockdown. And we wanted to assess, what's the worst kind of scenario that our banks would be able to withstand before they seriously got into difficulty. So we didn't look at the most likely scenarios. We looked at what we thought were plausible scenarios, but a lot worse than what the central projections were. So we drew our inspiration from a couple of scenarios that Treasury put out at the time. So in our less severe scenario, we assumed that we'd be in lockdown for a period of 2 months, but we'd also have a very weak global economic activity, and it would take a long time to pull out of the recession as we came out of lockdown. So this was a scenario where unemployment could rise above 13%, and we also thought house prices could decline significantly, so we put a 36% decline in house prices into the scenario, so a very severe one. But we also wanted to go even further. We recognised that there was a lot of uncertainty and we could have a worse outcome than that. So we said, what would happen if we went into lockdown for 3 months instead of 2 months? And we also had that very slow recovery. We also had a lot of disorderly adjustment in asset markets. So we thought, what if unemployment went to 18%, and what if house prices were to halve? How would the banking system come through an even more severe scenario like that?
Okay. What did you find?
Well, basically what we found is as we went through the less severe scenario, it certainly hurt banks, but it looks like they can survive that. So we'd see very significant problem loans coming through in the next year or so, and we think we'd get to the point where banks started to dip within their capital buffers, but would stay above the minimum requirements. So that's quite reassuring. We can kind of infer from that results that, up till that point, banks will remain quite healthy and able to support lending, and that's still quite a severe scenario. But then, as I say, we push further to find, what's that point at which banks really get into difficulty. And we did find in that second scenario that it did push banks below their minimum capital requirements. So it pushes them to the point that where they probably wouldn't be viable unless there was a significant capital injection. So that tells us something about, the limits of what banks can withstand.
Yeah, we've got to point out though that these are pretty extreme, very harsh environment that we're talking about, or scenario that we're talking about.
Yeah, exactly. So, there were 3 scenarios that were put in our recent monetary policy statement, and there were 3 scenarios that were put in the recent budget put out by Treasury. In all of these 6 scenarios, they were a lot more benign than either of the 2 stress tests that we ran. So these are, pretty extreme events and well beyond what we actually expect to happen.
Yeah. Okay. Look, you highlighted in the report that the COVID-19 contributed to the largest fall in GDP in 160 years. I mean, that's quite remarkable. But what does that actually tell us about the soundness of our banks?
So on the one hand, it's reassuring that, we think that even with that, the largest fall in GDP in 160 years, we think that our banks can come through pretty well and can withstand that. But one of the points we've been making in recent years is around the need to build resilience to what we call a 1 in 200 year event.
So are these linked, this 160 year fall and this 1 in 200 years?
I mean, they're somewhat different concepts. So when we think about a 1 in 200 year event, what really matters is the duration of this downturn and, some of the things that go with that. How much do house prices decline? How high does unemployment go? And how long does it take to recover? So just one year of negative GDP by itself does not make a 1 in 200 year event. And when we look at the scenarios that we run, we probably think that the very severe stress test scenario is more like that 1 in 200 year event. So it had to get quite a lot worse than where we are now.
Heaven forbid, we wouldn't want that to happen.
Yeah. And just to be clear, I mean, people thought that 1 in 200 was too severe when we were looking at the capital review last year, but we're now looking at something that's pretty similar to that sort of scenario, to the 1 in 200. And it's not just about banks being able to just survive, it's about them being able to contribute to the economy and to continue to lend with confidence through that. And that's really what we're calling on them to do now. And it's why, we were looking at quite severe scenarios in the capital review, so that it wasn't just that they could barely survive, but that they could actually play their part in the recovery as well.
Okay. Very good. Can we talk to lending? And I guess, Toby, for you for this one. Look, what do you see is the biggest risk to the financial system?
Yeah, I mean, I think it's probably some sort of vicious circle, actually. We're coming through a lot of pain at the moment, as I said. And, that's causing stress to households, stress to businesses, some stress to the financial system. When I talk about a vicious circle, what I mean is you could get scenarios where banks decide that they no longer want to lend. And you get something called a credit crunch, which is when banks are withdrawing, people are trying to sell their assets like their houses, because banks are not lending, mortgages aren't available, so there aren't the buyers out there for the houses, and you can get some sort of vicious circle in asset prices and in credit contraction. So I think that's probably the biggest risk that we see to the financial system going forward. It's not something that we're seeing imminently, and I think it's early days, But I think that the people of New Zealand and the banks are behaving pretty sensibly at the moment.
So are you then in that risk analysis, are you actually factoring in the support that, say, the central bank and the government have put in to ensure that there is liquidity?
Yeah. I mean, I think that's pretty important. I think both are pretty important. So the government have put in the wage support scheme, for example, and that's given people confidence. But also we provided liquidity to the system, and as I said, we've also removed loan-to-value restrictions, for example, so that banks don't need to worry about those sorts of constraints. Yep.
Yeah. Well, Chris, I mean, it does that question that Toby was pointing out. Look, we want banks to be courageous. Adrian has also made that point, the Reserve Bank Governor, Adrian Orr. I mean, there has been criticism that we don't think the banks, or some have thought that the banks haven't been really pulling their weight. What's the view here? Do we think that they are?
Well, I think it's still very early days, and as Toby points out, it's absolutely crucial that banks do continue to support their business customers, and that's going to be the most important thing as we go through the recovery phase. So what we have observed is that banks have offered a lot of relief packages to their customers so far. So a lot of customers have had big shocks to their income over the last few months while they've been in lockdown, and we're seeing 15% of business customers are under some form of relief at the moment, and 14% of household customers are receiving some form of relief. So there have been a lot of relief facilities that have come through, and that's been really important to get customers through this period. But I think as we look forward, and as we go into recovery, we're going to see a much bigger pickup in credit demand, and it's absolutely crucial that banks continue to support lending into the economy as we go through that.
Okay, so just to be clear here, we're saying that firms themselves, as they come out of recovery, they're still looking at the landscape and seeing what it means for their business. And so they're not necessarily drawing on credit until they get a better idea.
That's right. So most of the credit demand we've seen in the last few months have been the ones that have really been hurting and need some cash flow to get through the immediate impacts. But there's very little demand at the moment to actually borrow to expand activity. And that's what we expect to come through in the coming months, and where banks will need to continue supporting their customers.
Yep. I guess, Toby, we're almost looking at level 1 very soon. Do you expect the banks will become more confident in being able to lend?
Yes, I think I do, actually. I mean, you often get caution on the part of banks as to when the economy is starting to come out of a depression or recession. I mean, I think in this scenario, it's a lot more transparent and obvious. We're moving down through the levels from level 4 to level 1. A bank sitting there can say, well, yes, that means that these businesses are going to have more demand for their products because people are going to be out there spending more. So it should give the banks more confidence to lend. And not just to existing businesses, as Chris was saying, but there's often really good opportunities as you come out of a recession for new businesses to set up and take advantage.
Yeah, and then I take it,
that's what we'd like to see banks looking at as well.
And the possibility of the Trans-Tasman bubble. These are all upsides that we're seeing.
Yeah, I mean, it's just one example of an upside. Yes, yes, that's right. But I can't comment on when that might happen or whether that might happen, obviously.
Yep. I mean, part of all the key of this is the key that we've been expecting at the Reserve Bank anyway is for the lower interest rates that have been flowing through in the wholesale market flow through to retail rates. Chris, I guess, do you expect the banks to cut rates by more?
Well, I mean, I think it's fair to say that we've got relatively high deposit rates still in New Zealand given where the official cash rate is, and the difference between the official cash rate and deposit rates are as high as they've ever been. So we expect over time there probably will be some reduction in deposit rates, and ultimately that's what we need in order for banks to pass that through to lending rates.
Not so good for savers though.
No, not so good for savers, but I guess what we're trying to do with monetary policy is to get people out and spend and to get people investing in the productive economy. So we're deliberately trying to get people out and investing in riskier assets and get the economy going again, and that's one of the transmission mechanisms of monetary policy.
I mean, from a regulator's point of view, Toby, is there much more that you think the bank can do at this stage to kind of help encourage bank behaviour and get money out the door?
Yeah, I mean, that's a good question. Certainly from a regulatory point of view, I think we wanted to do as much as we could as early as possible. So we went hard and early, to borrow a phrase. So we relaxed all the regulatory restrictions that we felt we could. So that's the loan to value, the core funding ratio and so on. We put on hold various regulatory initiatives so that banks weren't distracted by having to increase their capital, for example, and look at systems changes, etc. I think we've basically done all of that we reasonably can. Anything else will be tinkering at the edges, but there's plenty that the bank can still do from a liquidity point of view. So pushing more money out into the system, so more lending facilities and so on. And that's not complete yet. There's much more we can do there.
Yep.
Yep.
Okay. Great, Chris. Look, one of the things that has usually been highlighted in the financial stability reports and perhaps has kind of been slightly downplayed this time is usually the level of debt, particularly in the private sector, and it has been a concern. And I guess if I looked at some of the sectors, dairy in one has been an issue in the past. What about some of these sectors? Are they even more vulnerable now than they have been in the past?
Yeah, but it's interesting. So the sectors that are most affected by this, by the pandemic and the lockdowns, are sectors like tourism, accommodation, hospitality. But these aren't sectors that have a lot of debt and banks don't have a lot of exposure to. So if you look at bank balance sheets, about 5/6 of their lending is secured on property in some way, be that housing, commercial property or farmland. So ultimately it's the transmission through into the property sector that will have the largest impact on banks. So for example, we think there are pressures emerging in the tourism sector. So where that'll hit banks is things like their exposures to hotels, their exposures to, retail properties and things like that. So as it starts to transmit into the property sector, that could have quite significant impacts.
Yeah. Actually, Toby, just on that, the commercial sector in particular, is that an area of concern from your point of view?
Yeah, I mean, the commercial property sector, yes. I mean, it's quite vulnerable. It is a sector that's quite prone to cyclical swings. It tends to be a fairly, high risk, high return sector for investors, which is a reason that banks don't lend very heavily into it. They tend to have quite conservative lending standards. But yes, I think as was highlighted in the Financial Stability Report, it is a sector that's looking like there's certainly heightened risk there. Yeah.
And one of the other aspects of this was the 6-month deferral on mortgages, for example, for households. That will roll off, I think, around September time or October. What about after that? I mean, how concerning is that particular area?
Yeah, I mean, I think it depends upon how quickly the economy recovers. So, just standing back, it looks to me like the loan deferral arrangements might have done their job. If the economy is bouncing back reasonably well by September, then a number of those customers who are on the loan deferral scheme will find themselves back in the position of being able to make the mortgage payments again, for example. But we shouldn't hide, and the banks also shouldn't hide from the fact that there will almost certainly be some people who unfortunately are a bit more challenged because their sector has been badly hit by the COVID-19. Yeah.
Look, I might just talk here about the non-bank deposit takers because we have been talking about the banks quite a lot, and quite rightly so. They make up a huge proportion of the sector. But what about the non-bank deposit takers? Are they safe?
Yeah, I mean, okay, so just picking up on that point you made, Patrick, they are small in total. I think they are less than 3% of the total deposits in the country. They're also quite diverse. So you've got credit unions, you've got building societies, you've got finance companies. And you can't just make a blanket statement as to whether they are safe or not. We did draw attention in the Financial Stability Report to the fact that some non-bank deposit takers have had relatively low profitability returns recently. They're entering the crisis in perhaps a slightly less robust state than most of the banking sector. But just to emphasise, that does not apply across the board to all NBDTs. It's a very varied sector. And if anyone is concerned, then I suggest they take financial advice or speak to their MBDT themselves. Yep.
Chris, just finally on this particular area, we did have a question from Stephen Hudson, who was asking whether the Reserve Bank had given any consideration to publishing more frequent dashboard bank lending or asset quality data post COVID-19.
Yeah, good question. So I guess we're always looking at how can we provide better information about what's going on in the financial system, and that's an ongoing effort. So even before COVID came along, we were looking at some of the asset quality data that we collect and whether we can put more of that out on a monthly basis, and we're hoping to do that in the coming months. But as we've gone into COVID, we've also asked for a lot more information on a higher frequency basis to understand how problem loans are evolving and how new lending is going in the economy. So as we, I guess, assure ourselves of the quality of that data and understand it, we will be looking to see whether we can put some of that out in the public arena.
Great. Let's turn to capital levels. Obviously a very controversial subject, particularly last year. And I guess it does beg the question, if we think that banks are going to well able to cope, and they have done so far, does that mean that you won't pursue your policy of getting them to increase their capital buffers in the future?
Yeah, I mean, good question. The short answer is that we fully intend to implement the capital review. It was a long and well thought out project. It took us about 3 years. We settled on a relatively conservative level of capital. We talk about the 1 in 200 recently. You can't be too precise about the numbers there, 1 in 200 years, but it's a conservative level. And I think what this crisis has shown us is that, things can hit the banking sector out of the blue. When we were going through the capital review last year, this wasn't one of the scenarios that people were talking about, but it's become very, very real. And as Chris was saying about the stress tests, there are some not implausible scenarios based off Treasury's own numbers where banks would actually fail to meet the current capital requirements. And that's one of the reasons why we were looking to increase them, and I don't think we want to resile from that.
Okay. You have delayed the start of the transition period until July next year.
Yep.
So is there a possibility that could be delayed again? And also, I guess it was a 7-year transition period. Could that be extended or lengthened?
Yeah, I mean, that's a good question as well. So at the moment, we're looking to restart the implementation 1 year late. So instead of 1st July this year, it'll be 1st July next year. That will be on the basis that, things are starting to get back to a little bit nearer normal by then. And that probably still is the, best case, even perhaps the central case scenario, depending upon how the pandemic plays out. But clearly, if there is a second wave, if the economy, doesn't respond well, if we have another downturn, if the banks are more challenged on their capital levels now, then yes, it's possible that we'd have to delay the start of the implementation of the capital review again. A 7-year implementation period still seems to me about right, but that's something we'd consider.
Right. Flexibility is your watchword in this case.
Absolutely, flexibility, yeah, that's right. Yeah.
I note that the Bank of International Settlement had noted that the lockdown, because it resulted in more people working from home, we had seen some higher levels of cyber attacks, and I wondered whether we'd seen any evidence of that here.
Yeah, cyber risk is one of those growing risk areas where we've been talking a lot more about in the recent years, and it's an area where banks themselves are worrying a lot more. And I think, as everyone's been working from home, it is a heightened risk environment. There is a bit more operational risk and a bit more cyber risk that could come through into the system. And it is important that banks remain mindful of these risks. So I think internationally there are signs that there is more cyber risk attacks happening. But in the New Zealand context, we haven't seen any instances of very severe attacks, but we are very mindful and watchful of that one.
Very good. Toby, one area we haven't talked about is insurers, who are again very important here. Yeah. Look, we have highlighted in the past, low buffers, very small margins. Should we be worried?
Yeah, I mean, again, like MEDTs, it's a very varied sector. So we've highlighted the fact in the past that there are some insurers with low buffers, and that remained the case going into this crisis. I have to say, though, that the stresses on insurers from this particular crisis are not as immediate or as immediately severe as they might be for banks. So, I mean, life insurers, for example, I mean, people would talk about the risk from deaths under COVID-19. You know, that's obviously so far not been an issue in New Zealand. The other big risk for insurers is lower returns on their assets. So that could be because of defaults on their corporate bonds, for example. Lower interest rates are not helpful, but none of these are immediately life-threatening to insurers. It doesn't mean to say that there aren't some insurers that went into the crisis, with very low buffers and still maybe have some challenges to restore their capital to a wider buffer.
Right, so in that sense, we're still keeping a very close eye on
we
the
are.
sector
Yeah.
and
Yeah, we
making
are.
sure that they're all right.
Yeah, that's right. Yeah.
Very good. Look, can we jump to deposit insurance?
Sure.
And again, another question that we had from Stephen Hudson was, when is the Depositor Protection Scheme likely to be finalised and operating? And what percentage of banks' deposits by value will be covered by the scheme?
So first thing is that's not within our gift in the Reserve Bank. It's going to be government decision as to when it's implemented. It is something that we support. We're supportive of the whole phase 2, as it's called. So that's development of new regulatory requirements, new prudential framework, which will include deposit insurance. So for those who aren't aware, the government has announced that there will be a deposit insurance scheme of $50,000 per person, per institution, per depositor, per institution. Direct answer to the question is that will cover 90% of depositors, so almost everybody in the country, and about 40% of deposits. So there are some depositors with very large balances, so only the first 50,000 of those deposits would be covered.
Yep. I guess that just given the situation that we found ourselves in, do you think there is some chances that this work will be sped up and brought forward?
Yeah, I mean, you'd never say never to that, but it's not something that's been announced yet. And at the moment, we don't see any compelling need to bring forward depositor protection. It's to give deposit insurance is to give depositors some confidence. It's to support people. And when they're, if there's an unfortunate failure of their bank or non-bank deposit taker, then they have then they can have confidence that they got the money for their groceries and day-to-day needs and so on.
We still have protections in place, don't we, for depositors?
Yeah. So I mean, there's two basic protections. So there's the fact that the banking system, as we've been saying, remains strong and stable. So that's the key protection. Our banks are in pretty good shape at the moment. And then we have policies in place like our open bank resolution, which will make sure that if there is a bank failure, very unlikely event, if there is a bank failure, then it can open on the next day, and depositors can have access to some of their money. Yep.
Okay, great. I think we'll leave it there.
Good.
Thank you very much for that. Look, my thanks to Toby and Chris for their time in discussing the financial system and its resilience during these uncertain times. We'd like to thank you too, obviously, for joining us, and for those who did send in questions. We did get some questions from some asking for financial advice. Unfortunately, that's not within our remit. It's something we cannot do. We do suggest that you do talk to a financial advisor on that particular issue. Mā te wā and goodbye.